Hi and welcome to the Devon Client Webinar. Great to have you along. Joined today by Slade Robertson. G'day Slade.
Great, how are you?
Good, thank you. And Tama Willis. How you going, Tama? Right.
Good, thanks.
Well, this is the last webinar for the year. 2022 has certainly been a year like none other. I think we would have said the same thing last year. But what the format of today is, we're going to talk and look at some of the highlights over the course of the year, and then provide a bit of an outlook for 2023. So I might start with you. Look, the Devon funds have navigated this year really well. Performance has been strong, but when you look at it, it's not just this year's performance, but it's been the last 3 years really. I mean, what do you attribute that success down to? I mean, it's been a great year. Obviously, on ACO, the Alpha Fund was voted the best Australian equities fund by Research IP, but what do you put it down to?
Yeah, well, thanks very much, Greg, and thanks everybody for coming along and listening today. Well, yeah, look, it has been a really good past 12 months, and as you rightly point out, if I go back to really where we were in COVID, the performance that we've enjoyed across our different Australasian equity strategies has been really strong, really since that point then. And when I think about this, and I'm often asked it, my view very much is it just comes down to the people that we have within the investment room. So we've got a big team of people. We have a lot of experience across the group. People like Tama are a great example of the experience and the depth that he has across the sectors that he covers and looks after for us. And that has really helped us to navigate, the very turbulent markets that we've had. When I think back over the last sort of 18 months anyway, one of the characteristics of the markets has been very much that it's been influenced by macro factors more than you have seen in other stages of the market and economic cycle that we're going through. And one of the real challenges that you face as an investor is to make sure that you can sort of navigate the noise or look through the noise to understand genuinely where opportunities and valuations sit. And we're really lucky that we have a team of people in the Devon investment team who are extremely capable and experienced in doing just that. So, from my perspective as a portfolio manager, I am just every day being sort of, provided information and views around, genuinely what different stocks and sectors are offering us in terms of risk return, and that makes my job a lot easier. So that's been, I think, a huge part of what we've and been through in the past, the past couple of years. So so people, again, it sounds a bit of a cliche, but genuinely, I think the group of people that we have are some of the very best in the Australasian markets.
Yeah, and when you look back at, and that's fantastic, when you look back at the year, what are you most proud of? Obviously, performance has been great, and people have been great. Is there anything else that sort of hits out? Obviously, we've launched a couple of new global funds as well. I suppose that's a development for the business.
Yeah, look, the business itself has gone very well, and I think and again, I thanks very much to all the clients for the support you've shown us during this period. So the business has remained in very strong shape. The two Wellington funds that you're referring to there was an initiative that we developed and came up with essentially in recognition of the fact that we were very Australasian focused. We don't have expertise beyond New Zealand and Australian equities, but we were, eager to provide our clients with a broader offering, and we spent a lot of time looking at which partners that we would go with in terms of the provision of both international equities and international fixed interest, which also had a very strong sustainability focus as well, and that's something that we're very proud of here in Devon. And we landed on the Wellington group, and they have been phenomenal. They both through the Impact Fund and the Sustainable Equity Fund, they are providing for us and our clients, I think, the solution set that we're looking for. So very good people to work with, and I'm very excited about what they provide for us in the next, the next part of our journey.
Absolutely. Well, look, might turn to you then, Tama. Talk about Alpha, the Trans-Tasman Fund. It's a great year as well. What do you talk about?
Yeah, I think just like you mentioned, we have a very good team, a lot of experience, and two new analysts who've been with us now for a couple of years, and we're also starting to cover sectors and businesses and making good recommendations to the portfolio. So definitely the team structure's worked in our favour, I think. So I would say in aggregate, just very good bottom-up stock picking. If we look at the wins across the year, names that we've had very high conviction in, BHP is a good example of that. Min Resources, another lithium play that has delivered a lot of alpha to the portfolio. Ben's the main analyst on that stock, along on secondary, but he did some very valuable work on that. And there's a long list of other contributors to the performance, whether it's Ramsay, CSL, high quality names that have delivered good outperformance for our strategies. I suppose the other side of it is, of course, we managed to, in terms of the underweights exposures, Fisher & Paykel Healthcare, we were very underweight as COVID receded, as the hospitalisations fell very sharply. We took the view that that would have a material impact on the revenues and earnings, which came to play out. And more recently, we've covered quite a bit of that exposure as it's fallen down to $19. So that was a large contributor to relative performance by being underweight at the right time and at the right size of underweight. We also, because we're very focused on cash flows and valuation, we've never really been big investors. We haven't really been investors in the space where you have to pay 20 times sales, or you have no cash flow, or break evens 5 years away. We've tended to be very focused, as you can see, as I've talked about already, businesses that are high quality with good cash flow generation, that you can make a fair value estimate of what the business is worth. A lot of those businesses that do not have earnings, that did well up to COVID and then rates rose, have fallen a very long way. Now we're not in any of those businesses, have not been, so have also benefited from a performance point of view, from relative performance, by not being in those businesses that have low levels of earnings or no earnings.
And then the environment, you still see it being conducive to good stock picking, and you're excited about next year as well?
Absolutely. I think that we are going through a period of volatility, and we're trying to find a floor in terms of where different economies reach in terms of their growth trajectories. But we don't, very difficult to make macro forecasts, we don't try and do here. But what we're looking at is what businesses are discounting. Businesses that have, for example, I'll give you an example of James Hardie's a building materials stock in the US. The US housing market has been weak, has been correcting for a whole lot of reasons. That James Hardie's fallen almost 50%. Now there will come a point that that's overly discounting the negative cycle. That could be now, but everyone has to make their own judgment on that. We do a lot of analysis. But there are a lot of names like that that are experiencing a weaker performance at the moment because the cycle backdrop is poorer. But we're starting to see some opportunities emerge in names, quite a number of names, which we're monitoring, doing the analysis on now, with a view to them at some point being strong outperformers in the year ahead. I think, and a lot of the names that we own across the portfolio, we see as multi-year investments with very strong value propositions. Names like, CSL, ResMed, BHP has had a very strong run recently on the China reopening themes. And unfortunately, we have had decent exposure to the resource sector during that recovery. And we did divest of some of our banks holdings and have been more overweight or have a larger exposure to resources during the last few months. So that's going to be a key theme next year, China reopening, which we're focused on, and some of the investment implications of that. And so, as always, there are a huge number of opportunities, and that's what gets us up out of bed every morning, and work hard, is to try and find those opportunities for our clients.
Excellent. I'm sure you will be all over it over the holidays as well. Anyway, that's fantastic, Tama. Thanks for that. Slade, might leave last word to you. So, 2023, what do you see? How are you calling it at the moment in terms of is it business as usual?
Look, it's I really enjoy these markets, and I enjoy them because there is a fair amount of uncertainty still in terms of how things are going to play out, and I think from the uncertainty comes the opportunities. We had a reasonably strong view that we would see a rally back in interest rates at the long end of the curve going back about 2 months ago, and that's played out as we'd expected, and it's certainly catalysed the performance of certain sectors and stocks that we have decent representation of within the portfolios. It's happened pretty quickly. I think some of that work now is probably sort of exhausted itself in the short term, but I think as we move into next year, we will likely see a continuation of it really from sort of second quarter through to the back end of next year. In the interim, over the next sort of 3 to 4 months, I expect that markets will be reasonably volatile. I think after having seen bounce off the recent lows, that we'll go into something of a holding pattern. Tama mentioned situations such as China reopening. So all these sorts of issues we need to try and get our mind around and understand how those sorts of events are being reflected in prices. But I think in a general sense, I suspect that markets just sort of go into a bit of a holding pattern. But where we'll be in 12 months hence, I think will be positive. I think markets will end up rallying on the fact that interest rates will continue to fall in a general sense as inflation pressures begin to ease. One of the challenges that we will find to counter that thesis will be the fact that we go into a slower period of economic outcomes, and that will create sort of headwinds for corporate earnings and profitability across a lot of the sectors that we do look at and invest into. And so we need to be conscious of this. And so ultimately what I think the message that people need to take away from today is to remain very diligent in terms of making sure that when you are committing capital into equity opportunities, that they are supported by balance sheets, by strong competitive positions, good management, these sorts of things that we often talk to. And I think that will remain very relevant. When I think about how we position the funds currently, we certainly have an overweight position to Australia relative to New Zealand. I think that we spend a lot of time in Australia and just visiting companies that we invest into and operating, in that market. And I think that the tempo in Australia currently feels higher than what we have in New Zealand. And I think some of the headwinds that we are likely to face here in New Zealand, won't be completely avoided in Australia, but I think that they are greater here in the short term. So at the moment we have more money in that market, but that is not a permanent feature. This is we do rotate between the two markets in accordance with where we see the opportunities. So that's where we sit currently. But I think next year ultimately over the 12-month period will be a positive one. Albeit I think the next 3 to 4 months will be characterised by a reasonable level of volatility.
Well, thanks for that. And thanks both for sharing your thoughts, and well done again to you and the team for the year you've had. So look forward to 2023. And we'll leave it there. We'd just like to thank as well all our clients for your support this year. It's very much appreciated. We'll leave it there, and I'd like to wish all our clients a safe and happy Christmas and a prosperous New Year. Bye for now.
Thank you.